deepest insider secrets you have about credit. Help us crack the code, because it is a little bit of a cryptic code that no one really knows. There's no real regulation around credit, so it's kind of like the Wild West, at least from my perspective. I've been doing this 16 going on 17 years and focused a lot on credit in my career, but even I'm lost half the time. So
Welcome
we got
to Loans Elevated, the podcast that brings you the latest industry news, expert interviews, and insightful discussions that will help you stay ahead in this dynamic market. I'm your host, Brock Lassick, and I've spent years in the trenches of the mortgage industry, helping individuals and businesses navigate the complex landscape of real estate financing.
I'm your co-host, TJ Heidenreich, and together we'll cover a wide range of topics, from business strategies that skyrocket your success to mindset and motivation that fuel your growth.
Hi, everybody. Welcome to this month's F.U.E.L episode, brought to you by Loans Elevated. My name is Brock Lassick, and I'm your host today. Now, before we get going, please be sure to be following us on all channels at Loans Elevated. That's our handle on every channel. Also, make sure that you're subscribed and following our YouTube page, Loans Elevated, and our podcast, Loans Elevated. You can find all of these channels along with a bunch of other really valuable information that has to do with mortgage and real estate, and like today, credit, at loanselevated.com. So please be sure to visit us there as well. A lot of great content. But I'm excited to introduce our guest today. This is one we've been waiting on and planning on for quite a while. So quick introduction. We have Juan Pablo. Most people know him by JP. He is the Regional Director of Community and Relations at UQUAL. So UQUAL is a partner of ours in business that we leverage to help our clients who are in a challenging credit situation, all different types of credit situations, whether it's a really low score, no score at all, or just one nagging issue that they can't seem to solve. We leverage UQUAL in our business in mortgage to help solve those issues for clients and optimize their loan terms. So they're really good. JP has been in the financial services industry for 12 years. For the past 5 years, he's been a key player at UQUAL. He has a very deep understanding of everything we're going to discuss today. He's a true expert. They say he's the go-to resource for their clients and partners like us navigating credit and loan readiness. So we're going to talk a lot today about loan readiness and credit. But right before we started, I challenged JP and I said, listen, dude, what we want is we want the deepest insider secrets you have about credit. Help us crack the code, because it is a little bit of a cryptic code that no one really knows. There's no real regulation around credit, so it's kind of like the Wild West, at least from my perspective. I've been doing this 16 going on 17 years and focused a lot on credit in my career, but even I'm lost half the time. So we've got JP here to help break some of this stuff down and give us the real truth behind a lot of these myths and what's going on with credit. So without further ado, JP, welcome.
Thank you, Brock. Thanks so much for having me. Excited to be here with you and help out, man.
Yeah, for sure. Thank you. So let's dive in. What is the one thing, like if you had to choose one thing, what's the biggest myth that you have to bust right out of the gate for people that might be listening to this and confused about credit?
So the biggest thing, it's going to be the amount of, and you said it real quick, there's so much information out there today. Before, it was really tough to understand credit because there was no information. Now there's a lot of bad information. The biggest myth is the fact that we now been ostracized and told that we need to carry a bunch of credit cards, car loans, student loans, all these things to create what they call a credit profile. When in reality, and you know this as a loan officer, you've been doing this forever, there's only 4 types of accounts that are ever going to hit our credit report, and that would be revolving, installment, mortgage, and then open or other. So in order for you to be able to have the perfect credit, you really truly only need 4 different accounts. Not in my community, right, the Hispanic community, there's this myth that you have to have 3 credit cards to have good credit. Well, we understand that 1 open and active credit card is enough to account for 30% of your FICO credit score. So to me, the biggest myth is that you have to have, the more amount of accounts that you have, the more credit that you're going to amass, and that's simply not true.
Got it. So you're saying the mixture of various types of credit accounts is important, but
Absolutely.
the quantity of each of those accounts is not important because that's crazy. I've even heard the same thing that you need 2 or 3 credit cards, and that is a real pivotal thing early on in credit. But you're saying no, just get one and then get a car loan and then get a personal loan or a student loan, and then if you can get a mortgage. And
Yeah.
that's like the trick.
And but right, like that's the dream that you and I get people to accomplish, right?
Yep.
So and let's talk about no credit, because this is the easiest thing. Because I've heard so many people, Brock, like, oh, it's easier to fix bad credit than it is to build credit. That's also absolutely not true. We can help somebody without a credit score in 45 days. So
Wow. Okay,
you
so
get
how do we
yourself
do
a
that? So you're saying you can take somebody, let's say it's a young person or a person who's just paid cash for everything their whole life, and they
Yep.
have no credit profile whatsoever. You're saying in 45 days, we can get credit built to get them ready to buy or
Yep.
finance a home.
Yep. And super
Wow.
easy.
Okay.
So
How do we
here's
do
the
that?
3 steps really quick. Number one, you already know this. We have to create some type of revolving activity, right? So revolving, AKA credit cards. Whether we like it or not, you know me and my rabbit holes, I don't like it, but we have to have a credit card. Notice I keep on saying a credit card. Have to have it. Why? It accounts for 30% of your FICO 2, 4, and 5 algorithms, and we'll get into that in a second. Number two, you need you need an installment. There's a lot of really good online tools. You can simply Google self-funded installments. Think about a digital piggy bank where I pay X amount of money every month. And as long as I'm making those payments on time, all 3 bureaus are going to show that I have an open and active installment. So now I have my R, right? My revolving. I have my I. Now I need an O. An open or other didn't exist till 2017 when there's a big lawsuit that happens and it involves Capital One, Macy's, and American Express. Get this, the reason they were being sued is that whatever your balance was, they actually reported as your limit.
Oh,
So you were
wow.
always
So everybody
you
was
were
maxed
always
out.
exactly.
Wow.
And I just said that how you use your revolving is 30% of your credit score. So you were missing 30% of your credit score, right?
That's
Well,
crazy.
so this whole thing goes down. American Express walks out of there like, phew, nothing happens. Why? American Express is not a credit card, right? It's a charge card. And so we have to then go to the bureaus and to all the credit servicers, right? Sactus, Factual Data, whoever it is that you use, and create a new type of account called O for open or other. Nowadays, a lot of people, obviously, when they're trying to build credit, they're not going to be able to just get an Amex. So nowadays, there's a lot of online tools where you can go and self-report to get that O. So now you have your R, your secure credit card, you have your I, your self-funded installment, and then you do some little self-reporting. That's your O. And with this 3, as long as you're doing things correctly, you get your M, which is what everybody wants, the mortgage.
Absolutely. Okay. Okay. So let's reel this back. Revolving credit card, just get some type of credit card. Now, as far as I understand, it doesn't matter what the limit is. If it's a
Correct.
$1 limit or a $20 million limit, that
Yes.
has no bearing on how good it is on the score. It's a percentage of use, right?
Yes.
Okay. So
100%.
just some type, because a lot of young people are worried that they don't have enough available credit. And the reality is it's like if you get a $500 credit card, which almost anybody could get, you get a $500 credit card as long as you're not charging more than $50 or certainly no more than 150, right? Somewhere between 10 and 30%. Is that right?
I love that you threw the 50 first, right? So let's talk about CCU, credit card utilization. I just mentioned it's 30%. Everything about credit is averages and percentages, right? So you can have a $10,000 limit, but if you're using $9,000 and I have a $1,000 credit card and I'm only using $100, who's going to get that 30%? Me.
Yeah, you get the better credit, right? Yeah.
Right. Because you're over leveraging the amount of credit that you have. So
Mhm.
again, the limit doesn't matter. Like you said, it's all about what percentage of my available credit am I using. Now, it used to be up to right about February 2023 when they changed the LLPA's loan level pricing adjustment. Doesn't matter. The point is we were mitigating, right? Market wasn't super hot. So we had to mitigate some type of exposure here. So credit cards do the same thing by lowering the CCU allowed, the credit card utilization. So nowadays, for the purpose of you getting all the points that you can possibly squeeze out of your credit cards, you want to be, before they report you, under 10% of your limit.
Got it.
Okay.
And they report you normally. Is that normally on the statement date?
No. So there's the due date, right? That basically, hey, Brock, pay me or I'm going to report you 30 days late. Even though you could be a day late, they're still going to report you 30 days late, right? There is no coding within the FICO algorithm to say, hey, Brock was late 2 days.
Oh, right.
It's 30 days automatically, right? And then you have your report date. So your report date is in the middle, like really tiny print in the middle of your statement. If you want to imagine your statement, it's right there in the middle. It says this is the billing cycle from this date to this date. That's when they report you.
So they report at the end of that billing cycle. So if it goes from like April 6th to May 5th, they're going to report me May 5th.
Yeah.
Got it.
And you could
Okay.
have several credit cards with the same servicers, right? So you could have 3 credit cards with Bank of America. Again, I don't recommend having 3 credit cards, but for the sake of this example. The funny thing, Brock, they're not all 3 going to report you the same day.
Oh, wow. So it's not based on the bank. It's just based on your account.
I want to do more research on it because I only carry 2 credit cards, one for international and one for local travel. Like, I want to go back and try to figure out, like, man, when did I get this credit card? Is my billing cycle based on when I opened it? Because you and I know that you can go and get a credit card right now, and it's not going to show up on your credit report from anywhere between 30 to 45 days, right?
Right.
So, and again, it is such a big part of the FICO algorithm. And that's the second piece that I really, really wanted to touch on today is it's not like rocket science. So
it's simple. Okay. Hang on just 1 second before we pivot away. We got the credit. Keep it at a 10% or less of the available credit. So in your example, $1,000 balance, less than $100, $500 balance, less than $50. That's critical A1 piece because that's 30% of your score is essentially having a credit card, but also keeping it at or below 10%. So then we have installment. Now, installment could be a car loan or a personal loan, but it also could be a secured account at like a credit union, right? Can't you go give them cash? If you have no credit at all, you can go give them cash to secure a loan. They'll give you a loan and then you just make payments and essentially get your cash back when it's paid off, right?
Yeah. So that's why I call it a digital piggy bank in a sense, because I'm basically saving money for something in the future. But yes, and that's why it's called a self-funded installment. The bank's really not giving me the loan, right? I gave them security.
Yeah, you gave them the
to
cash.
Provide me with a line of credit. Exactly.
Yeah. Okay, cool. So that's an installment. So there is a way to, because oftentimes people with no credit or little credit or bad credit trying to improve, they can't just go get an installment loan unless it's something like at a ridiculous rate and it's terrible for them. So, and then other or open, you can't always get an Amex. So you're saying go like self-report your utilities or your cell phone bill or something like that.
Rent, like if you rent, say that you're not renting from a private lease company, right? A lot of these companies today, when you're looking at your lease, it shows on there that they are offering services such as Rent Plus.
And that's the reporting?
Yeah, and so you're paying $10 extra, right, towards your rent. It's all built up, it's all caked in there. But they're actually giving that data to Rent Plus, and Rent Plus will put it on the credit report.
That actually, from a loan standpoint, I'm glad you brought that up because from a lender standpoint, that's a really important piece and could be the difference of an easy loan approval and a not so easy loan approval. If you had your housing history already reported on credit, it does streamline the process from a lender standpoint. 100%. So that's huge. Yeah.
100%.
So, okay, now I just wanted to make sure that we got those details kind of buttoned up and tied in a neat little bow. So now going to the next piece, essentially you're saying what every pro should say, which is it's not that complicated. If somebody's making it complicated, they're probably not a real pro and they're probably trying to sell you something. So right now you're going to help break down the simplicity of credit is what I assume you're going to do.
Yeah.
Okay.
So you and I have seen countless real estate agents, God bless all of you. on TikTok, on Instagram, talking about all these different things that have to do with credit, how to build it, how to remove things, and so on. The reality is that when somebody asks me a question about credit, the first thing out of my mouth is going to be this: which algorithm are we talking about? Because when we are talking about FICO, the Fair Isaac Corporation, we're talking about a software company, right? Every year, you get an email from FICO about their new FICO algorithm, FICO 10T, FICO V4, FICO A6, and so on. The reality is that since 1968, Brock, in the mortgage world, you, me, and everybody else have been using the same three algorithms, and I don't see any signals of that changing anytime soon.
Even though we've heard rumors. Yeah, you hear a lot of rumors, but
right. Also, Microsoft tries to push a new Windows every year, right?
Right.
How else are you going to sell software? So
Yeah.
FICO has to sell software. That's their job. Okay. Again, we've been using the same three renderings: FICO 2, FICO 4, and 5. 2, 4, and 5 is what every lender in the United States uses, unless you're doing private money. Completely different story. But for the purposes of getting a mortgage, you're going to be looking at FICO 2, 4, and 5. The beauty of these three models is that they're not that different at all. If they vary by less than 5%, but they're very unstable. And so let's break it down, because this is what, when I do classes in person, I love to do big classes for agents, for first-time home buyers. And I will ask them, how is credit composed? What is credit composed of? And I just hear all this stuff. And it's really 5 things. Just 5 things. And to
Wow.
make it super simple, you have your payment history, 35%. Brock, do you or do you not pay your bills on time, man? Yeah, I do. Fantastic. Do you or do you not have collections, charge-offs, repos? Even if, a lot of times people say, like, look, it's not a repo, I turned the car in. Unfortunately, the FICO algorithm is what we call a dumb algorithm, meaning it already has a certain set of rules that it plays by, and it cannot learn anything new. Okay? You can't go back and change FICO 2. It's good. They tried back in 3 years ago, they tried to change Equifax, and lenders were freaking out because people were getting the credit score wrong by 20 points up or down.
Oh, wow.
And so that didn't work out. It was a failed experiment. It lasted almost 6 hours, by the way.
Oh my gosh.
Well, imagine a person that had a middle score that was perfectly fine for you to get approved, and suddenly it dropped by 20 points.
Oh yeah. I mean,
And
that
you
could
have a
make them not
pre-approval.
approved anymore. Yeah.
Right? That's a big deal. Now
That's
imagine
crazy.
that nationwide. It's a
Yeah.
big deal. So anyways, 35% is whether or not you pay your bills on time. That's it. And again, the repossession example is, even if you turn it in, the FICO algorithm doesn't know the difference. The difference between a repo, a credit card that went bad with Capital One, a loan that you didn't pay with USA, or your Verizon bill. All it knows is that it sees the code number 9, which means collection or charge off. That's all it knows. And while you and I understand that there's a story behind every account, the FICO algorithm doesn't understand that, okay?
Yeah.
So 35%, do you or do you not pay your bills on time? 30%, we already talked about it. Having an open and active credit card and maintaining set credit card before they report you below 10%. They're 65% of your credit score.
Wow.
Now,
2/3 of your score. Just pay your bills on time and don't overcharge your credit card, but you
that's
have
it.
to have one.
Have to have one,
Yeah,
right? And
yeah.
again, I could argue, and you and I know a lot of people, well, Dave Ramsey says you shouldn't open credit cards. Well, if you're trying to buy a house, you kind of sort of have to.
Right.
You
Well,
have
the
to.
crazy thing is, if you don't have a credit card, you are actually missing 30% of your score. You don't even have a chance. That's crazy.
You can't. But here, guys, and I'll try to stay out of the rabbit hole as much as I can. You do understand we live in the only country that you need to be in debt to be lendable, right?
Right. It's wild. But we also have access to way more credit than any other country, which
It's wild,
is good and bad.
right? And I listen to you guys' stuff all the time with you and Ryan, and I mentioned this, like the thing that the episode that you guys made on Affirm Everybody should listen to
Oh
that
yeah, buy now, pay later. That stuff is
because it can
crazy.
wreck your credit so quick, just super quick. I just saw a client with 6 collections under $16,
Oh my gosh.
and they were all from a firm. Anyways,
Wow.
so
That's brutal.
65% payment history, 30% credit card utilization, right? Your revolving credit. The next one, super, super easy. It's called new credit. You and I know it as getting your credit pool, right? 10% of your credit. Don't have your credit pool more than 10 or more than 6 times a year. Just don't do it. Okay.
Okay.
Easiest way to avoid that, don't go to a car dealership.
Right. Yeah, I
So
got hosed on that one time. They're like, "Do you want the best rate?" Of course, I said, "Yeah, I want the best rate." They pulled my
how
credit
many
like 25 times the same moment. My score
yeah,
went down 20 or something points for like 2 years,
yeah,
and I couldn't get it to recover.
yeah.
So
So
you're saying
inquiries will
six
stay
times
on
a
your
year is
credit for two
okay?
years.
Six
Sorry, go
times a
ahead.
year, 6 times per year credit pull's okay.
Yeah, because an inquiry lives in your credit report for 2 years, but it only gets taken in consideration towards your score for 12 months.
Got it. Got it.
But that
Okay.
what happened to you, right? Not only the fact that you got shotgun is what it's called. It's a practice called shotgun. They take your application and they sell it to a bunch of banks to see if they can get you the best rate, which in reality, we know they're going to sell that paper, they're going to sell that loan, and they're looking to see who's going to give them the largest commission. This
Right.
isn't about you. Okay. They hate me at dealerships because I'll show up in a hoodie with an 800 credit score. Anyways, the idea is you don't want your credit because the way that the FICO algorithm looks at it, you could be a multimillionaire, okay, and you want to buy a new RV, a new boat, a new speedboat, whatever, it doesn't matter. The FICO algorithm, it's a dumb algorithm. It can't understand those things. All it knows is you're trying to take out more debt.
So, a
Okay.
question about that. So it doesn't matter what type of debt you're applying for. It could be a $2 million boat, or it could be a $500 credit card. Algorithm sees it the same way. So if it's six, could I get all six in January and none the rest of the year? And that's treated the same as if I got one in January, one in March, every other month? Is that the
So
same
it depends
or?
on what you're applying for, right? So let
Okay.
me help you as a loan officer. You're going to love this. There's only one shopping window. It is for mortgages only, and it's 30 days. Okay.
Oh, really? So that is true.
It is true. You can
Wow.
go shop around for a car loan, or like Brock here, you're gonna get your credit pool 25 times, right?
Hmm.
The only coding within the FICO algorithm where it understands that it should only count it for one is when you see mortgage hard inquiries within that same 30-day window, right?
Wow.
Because and you have to, as a loan officer, I know you give this disclaimer. Hey, you can shop the rate around for the next X amount of days. But to be safe, only for mortgages, 30 days to be in the safe side.
Yeah, that is really good to know. We most of the time do a soft pull nowadays until they're actually going under contract so that we can avoid the hard pulls altogether until they know for sure they're rolling with the loan. But that's really interesting to know because you do hear that idea of a shopping window. And I was always wondering, is that real or not? And it sounds like for mortgage, it is, but only for a month, 30
It's
days.
only for mortgage. Yeah, yeah, yeah. And it's only for mortgages. Like a lot of that myth comes from the car industry, right? So you have Jeep here, Dodge here, and across the street you have Chrysler. There's a reason for that. Okay.
Right.
And by the way, people should be very, very thankful that you do a soft pull. Otherwise, they become trigger leads and then they're flown bows out.
Oh
It's
yeah, we had a client the other week. We did a hard pull, and we normally give them that. Gosh, what is it? It's the
all-out
FTC's
screening.
opt out pre-screen. We
Yeah.
give them that to prep them for it because we do the soft pull, so they have a couple of months. We had a guy that didn't do it. He said he counted 500 calls in one day. 500 trigger
And I'll
lead
tell
calls
you,
in
I'll
one
tell
day.
you a really crazy story about that. But let's finish this breakdown, right? So we have 5 pieces. We already covered new credit or inquiries. Don't get your credit pool a bunch of times. Credit cards, one under 10%. Paying your bills on time, 35% of your credit score. Your credit mix. We talked about that, RIMO, RIMO. So this is 10% of your credit, and it works this way. I have a car, just a car loan, and 3 credit cards, right? I got 4 lines of credit. You have a car, a house, a credit card, and an American Express. You also have 4 lines of credit, right? We both have 4. but your mix shows that you're capable of managing different types of credit. So you're going to get that 10%, and I'm not.
So in theory, those people are always going to have a credit score 10% higher than the others.
Yes.
Got it.
Yeah.
Okay.
So you have one of each. I have one car, 3 credit cards. So what I will have to do is shut down 2 of my credit cards, get an Amex, and go buy a house. Or I go and buy 2 more vehicles, take out 3 Amexes, and buy 3 houses, right?
Right.
It was a 1-to-1 ratio. And this is where I'm saying, like, it's very, very unstable, because in that particular portion of the algorithm, it almost becomes binary. It loves the number 1 and hates the number 0. That's why I never tell people, and you know this, but I think a lot of the people listening are going to love this. I tell people, don't ever pay your credit cards down to 0. I feel like people pay their credit cards down to 0, and it's like a badge of honor that they wear.
Right. Right.
But the thing is this. I told you, it's an algorithm that can understand or learn new things, right? So if last month your balance is 0, this month is 0, and next month is 0, what do you think that the algorithm thinks is happening?
It's just not being used, right?
Okay, and so if the account is not being used, is that particular credit card company making any money off of you? No. Is there a cost to that particular credit card company to maintain your account?
Absolutely. Yeah.
Okay, so if you don't use it and it costs them money to keep you there and you're not making them any money, this is why you're seeing people's credit cards get shut down left and right now.
So question for you, if it reports 000, let's say they don't shut it down, does the algorithm think that, does it just assume you don't have that type of account anymore? Because I have seen that people's credit scores can actually increase by charging a balance if they have no balance on any credit cards. Their score goes up.
It's
That's
really a glitch.
Oh,
So like
wow.
if you had a borrower that only needed like 5, 6, 7, 8 points, the first thing I'm gonna do is, oh, cool. These 2 credit cards are at 0. Go to Starbucks. Take Brock out to coffee. Pay 1 coffee with 1 card, the other with the other, and voila, watch your score go up. 5, 6, 7 points.
That's crazy.
The reason behind this 0, right? You also have to understand that a lot of how the FICO algorithm was made, which, by the way, we're using the same damn thing that was created in 1956. So Errol Isaac is a mathematician and Bill Fair is an engineer, and they got together and put together this thing. And that's where you get the FICO.
Interesting.
Yeah, 1956. How credit cards got invented is even crazier. But that's the 10%, right? Now you have the credit mix. The last one, so real quick, 35%, do you pay your bills on time? Yes or no? Is your payment history. 30%, your credit card utilization. 10%, not getting your credit pool a bunch. 10%, it's going to be your credit mix. And the last one, and this is where everybody makes mistakes, okay? Everybody makes mistakes. It's your length of history. Very simple. I have a credit card that is 10 years old. Therefore, my length of history is 10 years, okay? But I went shopping this weekend, and man, I really fell in love with that big screen TV. And I'm about to get out of there with the big screen TV. It won't even fit in my car, it's so big. And the guy looks at me right before I'm paying and says, what? Would you like to open a credit card for a 15% discount? Man, a 15% discount sounds really nice on like a $3,000 TV. And so I never listened to the podcast before, and I say, yes. Yeah, let me get that credit card. So I had one credit card on this hand that was 10 years old. On this hand, I now have one that is 0 years old. 10 plus 0 is still 10. My length of history is still 10 years. But now I have to take those 10 years and divide it between 2 credit cards.
Oh, wow. So the history of accounts is an average of those types of accounts? No kidding. So you don't want to open new accounts as if you can avoid it, basically, is the point.
Well, if I had 10 years and now I have to divide it between 2, I now have 5. And so what I'm telling you is that 15% of your credit score, FICO 2, 4, and 5, it's based on your length of history. If I just shot my length of history by half, I technically lost 7.25% of my credit score because I took a 15% discount on a TV.
Wow. That's crazy. I'd never heard that.
And so think about this, right? How many times have you had somebody complain that they paid off their car loan? Oh man, I finally did it, Brock. I am student loan debt free. I pay my student loans, they are gone. And guess what? My credit score dropped. Why?
Because they don't have that history, I guess, right? Now it just is. That's crazy.
Brock, you pay that car religiously, man, on time for 5 years. Okay, 5 years, man. You never missed a payment. Everything was beautiful. The moment you made that last payment the following month, there is no reporting of a payment, right? Because you don't have to make a payment.
Right.
That money's in your pockets now, man. It's fantastic. You just lost 5 years of history because you paid off your car.
Dang.
And on top of that, remember that big 35% of bite of the chart? Imagine that chart, that pie.
Yep.
35% is whether or not you're paying your bills on time. Well, you're no longer making an on-time payment on a car loan.
Does your home and auto insurance seem to go up every year without fail? Mine did too. I thought this was just the way the insurance industry worked until I found my friend Alan Johnson with American Family Insurance. After more than 15 years with the same insurance agent, he saved me over $3,000 per year when I switched. I refer all my family, friends, and clients to him, and their experience is similar. Great rates and a great experience. Call Alan for a free quote today at 801-708-2962.
So you're not going to get points on to that either.
So it's a double-edged sword. So what is the solution? Because like I tell my clients, get rid of all consumer debt. Get rid of it. Like you spend on a credit card, so you have that history, have a mortgage, but everything else, eliminate it. That seems like a slippery slope, I guess.
No, I'm 100% on board with you.
You like that? Okay. Okay.
Yeah. Look, my best friend he lives the dream in here. We call him a ghost. He does not exist in the credit system. Beautiful cabin, beautiful house up in Red Feather Lakes, federal land. No credit cards, nothing. Cars are paid for. It's beautiful. Like ultimately, the more that I learn about credit, the more that I want that.
Yeah.
Right? I don't want to get to that point. So continuing with the car loan thing, right? You paid off your car, you're going to lose a lot of history. You're going to lose some of your on-time payment history. You're also messing up your credit mix, right? Because remember, you had one car, one house, one credit card, and one Amex. Well, now you don't have the car anymore. So you messed up your history, your credit mix. It's almost like the back of a watch, right? And you take it out and you tinker with one tiny thing and you mess everything. This is why I said that it's unstable. So if you have an 800 credit score and you get one late payment, you're likely going to lose somewhere around 100, 120 points.
Wow.
If I have a 500 credit score and I get a late payment, I'll probably lose 20, 30. The higher your credit score is, the more damage than anything derogatory does to your credit. And that goes for collections, medical bills, whatever the case may be.
Wow.
Because everything is a percentage of 850.
Yeah. That's crazy. All percentage based. Dang.
So somebody with a really high credit score goes to Macy's, gets a credit card, versus somebody with a 600 credit score. Do the math. Take 15% or 10% or whatever out of 800. Oh, you lost 80 points.
That's
But if
crazy.
you only had a 500, you lose 50.
Right. Yeah. Yeah. The bigger guy falls harder.
Yeah.
Bigger score falls further.
And it's an analogy. Like I always like the analogy. Like I'm standing on a building, 800 stories tall. You're standing on a building, 420 stories tall. We both jump. Who gets hurt the most?
Right. Right. Right.
It's been designed that way. Okay.
That's crazy. So one question we haven't hit on, we've hit on a few that I had kind of in my mind to ask, but one is collection accounts. I tell my clients, like until they talk to you, don't pay anything off, because sometimes if you pay a collection account off, your score gets worse. And I think that's because they re-report, so it looks like a more recent derogatory account. Maybe that's true, maybe it's not, but I guess what's your thoughts there? That's why?
That's exactly right. So you and I know when we look at a credit report, we don't care about the balance of the collection, right? So you and I go play basketball. We go and challenge a ball at the rim. We both fall down, hurt our ankles. We both end up at medical bill. Okay. Your medical bill is $5,000. My medical bill is $50,000, and it hits our credit report the same day. We lose the same amount of points.
Wow.
The balance, just like the limit on your credit cards don't matter. Remember, averages and percentages, right? So just like the limit on your credit card doesn't matter, so stop flaunting your Amex, people. The balance on a collection doesn't matter.
So
Why?
balances mean nothing on any type of account.
Not for FICO, it does for you as a DTI, right? As a
Right,
loan
of
officer,
course.
you got to,
Right.
okay, so for DTI, yes, but for the sake of your credit score, a balance of a collection does not matter. Why?
Wow.
It is wealth discrimination.
Dang, that's crazy.
People with more money will inherently have more credit.
So it's the quantity of accounts and the percentages of
The
things that
date.
matters.
You and I know this as the DLA, the date of last activity. It's in
Mhm.
everybody's credit report in every single account. What is the date of last activity? The last time you paid them or you didn't pay them, right? So in the state of Utah, everything on your report can sit there for 7 years, right? So let's just pretend you have a client. The client has a collection with Verizon. It's $462. It's 5 years old. They paid it today. Verizon has to go to the three bureaus. Hey, this guy paid me. What's the balance? Zero. Cool. When did he pay you? Today. The date of last activity, therefore, becomes today. So by paying a collection in the scenario that I just gave you, that imaginary person just created themselves a brand new collection for $0 that's going to sit on their credit report for the next 7 years.
Oh my gosh. So it restarted everything.
Everything.
Holy cow. Wow.
And remember, is the FICO algorithm smart? It's not, right?
Yeah, no.
And does it take in consideration balances? It doesn't. So a $0 collection shows as being a brand new collection.
Wow. Wow. So percentages, quantity, and dates is all that really matters.
The
Dang,
more
that's crazy.
recent, the
Okay.
worse.
So now let's talk about, because we get this a lot. I'm sure you do probably more than me, where somebody calls and they're like, yeah, I've got, Credit Karma, or I have my Amex that gives me, or Citi, any of the, name them, Capital One, all of them give you a credit score. And they're always different, and sometimes better, sometimes worse. That is because they're using different algorithms. Is that the deal?
Yeah, yeah. So I'll say my dad has the best lines for everything. So Credit Karma, Credit Wise, Credit Sesame, Credit Journey, Credit whatever your mom says it is, right? They are all free. And my old man always says, if the product is free, you are the product.
All right.
What are you giving to all these apps, right? What are you giving in return for a free credit score?
So
Data.
they're selling people's information and providing a free score, but the free score is worthless because when you actually go get a loan, it's not even the right score.
Yeah, so let's go into that. Everybody today is going to get home after work. They're going to open their mail. There's going to be what in there? The pre-approval, yeah?
Mm-hmm.
Back in the day when I started building credit, there was no such a thing as pre-approval. It was just an application invitation.
Oh,
Okay? Now you're pre-approved. Well, how the heck do you know I'm pre-approved if I didn't ever let you pull my credit? Well, somebody clearly saw your data to Capital One, Discover, whoever. So TransUnion, Equifax, Experian make money by selling data. That's why
that's
you are.
crazy. So I wondered why. When you log into these accounts and every month or 3 months or whatever, they're like, hey, update your information. Is your income still this? Is this still that? That they're doing that so they have an up-to-date application and they can just resell it every quarter or month or something?
It is the biggest, most successful marketing campaign that nobody knew exist.
Wow.
You are willingly giving them information. Credit Karma also owns QuickBooks, or actually they're owned by Intuit. So they have QuickBooks, TurboTax, Credit Karma, Mint Budgeting. Now they know how much money you make, what you spend it on, when you get paid, the frequency in which you get paid. They know when you get a raise. They know when you
That's
cut your
crazy.
hours. They know everything. As somebody in the financial world, what more could you possibly want to find your perfect candidate?
Yeah, exactly. I mean,
You
that's
know what? You
insane.
have everything, everything.
Yeah.
So they're going to call the credit bureaus, hey, let me get 460,000 profiles in this particular area code in the age range between 26 and 36 with credit scores sub 720, but higher than 615. Why? Because that way we can throw, I guess, 460,000 applications, pre-approvals, right? Pre-approvals in people's mails. They already know how much money they're going to lose. They've already calculated the percentage of those people that are going to apply and not get approved, the percentage of those people that are going to apply and likely default within 6 months. They already have all of this calculated.
Mm,
Okay, there is no mystery. That's
that's
the
crazy.
same thing that you're seeing. And I didn't want to forget to bring this up. You mentioned you had a client that the guy counted, you said what, like 500 phone calls?
Yeah. 500 phone
Okay,
calls
they're
a
not
month.
human beings.
Oh, those, no kidding. That's against the law though, right? I
No,
guess they
it's
don't care.
AI. It's all AI. So you can like, and you can be like, JP, whatever happened to the opt-out screening that we talked about? Whatever happened to the do not call list? There is no regulations against free marketing from AI agents. So the way that I learned this, I had the pleasure of being at a class where I think there's a huge difference between an educator that talks at you and a communicator that talks with you, which is why I love doing this,
Yeah.
right? Because you and I are learning and pulling from each other, going back and forth. But as a communicator, you need to know how to say things in a way that you always win. There's a really, really good book, and the author's going to kill me because I can't remember it, but it's called Know Exactly What to Say.
Oh yeah. I don't remember. He's a stud though. I agree. He's a rock star.
British guy. I actually
Yeah.
met him in person, got to hang out with him. And I use a line that he has, like my favorite magic word, he calls it the magic words, is did you know? But they've also trained this AIs to say things like this. Hey, Brock, I know that you had an application recently with cross country, the Lansing team, but I was wondering if you are open-minded to having a short 3-minute conversation and talking about potential buy down. Everybody wants to be open-minded, okay? So the answer is going to be yes. The other one that they use is just imagine. Hey, Brock, just imagine having just a quick 2-minute conversation that could potentially save you hundreds of thousands of dollars on your mortgage rate. And then the one that I identify right away is the way I see it. The way I see it, you have three options. You stick with the offer that you got, okay? You do nothing and continue to rent, or you talk with me and potentially put PMI and a bunch of money in your pocket. These are not humans, right? Like here in
That's
Colorado,
crazy.
I took my son to Wendy's the other day. Um, and I got the kindest, nicest, most upbeat person taking my order. And like the way that it was upselling everything, I'm like, there's no way, right? Because what do you get at Wendy? A high school kid, usually.
Right, right. Yeah, for sure. They don't
So I
care.
get to the thing and I realize, I was like, dude, like, who's taking my order? Like, oh no, we're doing this test. We're in beta for testing the new drive-through AI.
Oh, wow.
Turns out that they're upselling by more than 15% on every order. Even if it's like, oh, do you want a slice of cheese on that? It's wild. So
That's crazy.
there's good uses and bad uses for it, but what bothers me, right? And the reason why I used to love Credit Karma, man, I thought it was a great, great, great tool because finally somebody was putting credit in the front of your face because nobody
Mhm.
had done it.
Right.
But then when they start, and it's not just Credit Karma, I like to call them online scoring models because it's all of them. But when they start monetizing data, and I've said this in every podcast, every show I've ever been, that's when I'm done, right?
Mhm.
Like Instagram, it's catching your data, man. Like I do presentations and I have the agents put their phones right side up and I will talk crap about credit repair minimum 3, 4 times. Guess what's the first thing that shows up when they get in? Credit repair.
Right.
You see what I'm saying? So here goes the Credit Karma, Credit Wise, Credit Sesame, Credit Journey. The reason why it's completely different, and yes, maybe in 1 out of 1,000 cases is higher, but in the other, 999 is going to be lower. It's because use something called a residential mortgage credit report. They use something, or they give us something called a consumer credit report. So really, really quick, this is how we diffuse that entire conversation. And here's my magic word. Did you know, Brock, that in the mortgage industry, we look back at 7 years, right? But these online scoring models only go back 28 months.
Oh, really? That's why they're so different.
That's one. Let's agree that prior, like 3 years ago, 3.5 years ago, whatever, we all went through a major global pandemic. People lost their job, paid their credit cards late, car loans follow, right? When you're looking at this online apps, all of that no longer matters. Poof, gone with the wind. But when you pull
Wow.
credit, is that going to be on there or not?
Absolutely, yeah.
Absolutely. So number one, historical data versus trending data. That's number one. Number two, we were talking earlier about having your credit cards at or under 10%. Okay. The online scoring models, they don't hit you, they don't penalize you as long as you stay under 50%.
Oh, wow.
So let me
And
ask
that's
you a
the
question.
third tier in our world. It really
Right.
goes from 10 to 30 to 50, right? Those are kind of the
Yeah.
tiers in my world.
Yeah. And so not only that, let's talk real quick for the purpose of purchasing a home. If I come to you with 12 credit cards and all of them are at 50% utilization, what is that going to do to my DTI?
Right. Yeah, it's going to be terrible.
Exactly. So there's two. Number three, medical collections, no matter the balance, right? Balance don't matter. We agreed on that earlier, right? Medical collections do not get scored by online scoring models at all.
Do they get scored by ours now? Because I've heard rumors that those are falling off or going away on even mortgage reports.
We'll talk about that next if we have time.
Okay.
Because that's a big point of confusion. But let me put it this way. Remember what I said earlier about the FICO algorithm being a dumb algorithm that can't understand or differentiate? It can't know the difference between a medical collection or a phone. A collection is a collection is a collection. Yes, your algorithm scores them.
Wow, that's crazy. So it's a matter of how much do they police the medical reporters for reporting medical, because they're not supposed to report them, but if they do, it's just the same thing. It doesn't know the difference.
Careful.
Are they supposed to?
Yeah.
I guess, what is the rule there?
So put a pin on it because we'll get to that next.
Okay, cool.
Because there's a lot, and I actually want to give you the timeline.
Yes.
Let's just nerd out while we're at it. So medical collections do not get scored at all by this online scoring models, while a loan officer, with certain caveats that we're going to talk about, do score the collections because it doesn't know the difference whether it's a collection, a positive contract, negative contract. It does not know. Okay. 4, and last one. I've already said several times that the balance in a collection does not matter. Okay. Online scoring models do not score any collections that are under $100. Right? Doesn't make sense. I am already seeing, May and June. This is right about the time. The timeline is perfect. One of the most prolific collections under $100 are starting to pop up, and it's going to get worse next month. Gym memberships, right? Everybody starts in January. Time to give up by now.
Right.
So,
and on our report, it doesn't matter if it's zero. It's still going to get crushed just the same way.
Exactly. Wow. And so, hey, how come you are giving me a lower credit score than whatever my phone says I have? Well, hang on. And here's the magic word. Did you know that I'm looking at 7 years, also known as historical data? They're only looking at the last 28 months in most cases. It's called trending data. Also, we want to make sure that you're keeping your credit cards under 10%. They're not going to penalize you at all as long as you are at 50 or below. Medical collections don't get scored. We do look at them. And then collections under $100. That's a huge difference.
Yeah, huge difference. And those are the types of clients that the disparity is so significant, are the clients that have those types of accounts, those scenarios. As you're saying this, I'm like, wow, that makes sense.
No, over leveraging of credit cards. If it wasn't for over leveraging of credit cards, the notifications that this application send will go down by 90%. So the marketing plot, right? Your credit score is up 6 points. Your credit score is down 12. Your credit score is up 9. Your credit score is down 4. They're just keeping people clicking. It's clickbait.
Oh, right,
That's all it
right.
is. You and I know a
Those
credit score does
SOBs.
not change like that. It doesn't change like that, right? So
Yeah,
what they're
for
doing is they're
sure.
just tracing your balance, right? They know, oops, you just hit 11%, time to send you a notification.
That's
Um,
funny.
does that make sense? Like
Yeah.
I want to make sure I cover that because to me that's huge, especially for our realtor friends out there that are the first line of defense when they're hitting you with my credit karma says a 620 and you pull a 560.
And the crazy thing is just like what freaks me out a little bit is this capitalistic approach of monetizing everything and how big of a deal that's going to be with AI. Because, I mean, we are just scratching the surface. Everything's going to be freaking automated. It's going to be nuts. I can't believe that.
I I just saw AI within 7 days. This guy had a couple of accounts. I can't tell you what the accounts are, but I can tell you that within 7 days, it was able to leverage the Fair Credit Reporting Act, and the guy's credit score went up 62 points.
Oh my gosh, you're kidding. Okay, so it could be
So,
used for good. It's not only a villain.
I mean, like, and it's like, so outside of this forum, I teach youth ministry and kids ministry, and
Oh
like to
wow,
share
cool.
my Christian faith. And a lot of times when I tell people that I work for AI, they're like, "Oh, well, like, ooh, you're the devil." And I'm like, "Look, when you open this out of the box, this wasn't good or bad, right? I can use it to do good. I can also use it to beat you upside the head with it, and it's bad." It's
Mhm.
like everything, right? Everything's neutral. It's just what we're using it for. The problem is that, and I'm 100% in agreement with you, is we live in a society where we're going to capitalize and monetize everything.
Mhm.
We can't just let it be, right? Somebody's got to make money out of it. It is what it is. Um, so the
That's
reality is
crazy.
that while I'm really good, and a lot of the people in my team, like I can read a credit report blindfolded, but I
Mhm.
can't AI a credit report.
Right, right.
I'm never going to get to that level. And what's amazing is that Alex is the name of our AI, and she continues to learn more and more and more about, well, factual data puts it this way, but Advantage Credit codes the same thing a little bit different. And so it's starting to understand where we can find things that are a violation of the Fair Credit Reporting Act,
Mm.
which it's a federal law. It was passed in 1970. It's 169 pages. Here's what you care about.
Well, and the crazy thing is if you can actually get a creditor or a bill collector dead to rights on a fair credit reporting violation, I mean, it completely changes everything. They no longer are arguing. They'll just delete it if you can bust
They
them because
have to.
they'll shut them out of business basically if they violate that type of thing,
They
right?
have to. And so the way that I explain it to clients and my partners like yourself is, let me take 169 pages and put it into one sentence for you because this is all you're going to retain and all you're going to care about.
Right. It's all you
Everything
need.
on a consumer credit report, everything on a consumer credit report by law has to be 100% complete, accurate, and verifiable.
Wow.
If the account or the trade line does not meet all three of those criteria, they have to delete it from your report, period.
Wow. That's crazy. Can they just go back and re-report it or no?
No, no, because what you're doing is, again, you're leveraging the Fair Credit Reporting Act. I'm not just throwing random disputes everywhere, which is what, right? Like go to Credit Karma.
Right.
You can go on Credit Karma and hit like, oh, I want to dispute this. And basically it says, I don't know this account. This account is not mine. I don't remember opening this account. They're basically giving you two answers, 14 different ways.
Mm-hmm.
And so let me ask you this, because this is actually quite interesting to me. You pull credit and you look at the credit report and it says account disputed by the consumer. Right underneath, and this is kind of new, it says dispute resolved by the credit grantor. Why is a bank or a financial institution going out of their way to let you, Brock, the loan officer, know that that person disputed the account and that they, the bank, the credit card company, whatever, resolve said dispute? Remember, it used to say customer disagrees or dispute
Mm-hmm.
resolve
Mm-hmm.
customer disagrees. Remember, it used to say that?
Mm-hmm.
Now that verbiage is changing. And so I was on a phone call that I had no place being. I had the blessing of sitting right outside the owner of the company, and he'll, call me in, which is the international symbol for come in, shut up, sit down, take notes. And so he was asking to the guy on the phone, which turns out is an ex-employee of Equifax, but he was asking the guy on the phone, hey, why did that change? Why are banks putting that they are the ones that resolve the dispute? And the guy goes, hey, yeah, that's how we tell each other that person is a liar. And I was like, dang. So you said the account is not mine, right? That's what a blanket dispute is, right? You know this, your underwriting department loves dispute verbiage. They're just, the account's not mine. Well, guess what? I have your name, your address, your phone number, your date of birth, and your social. It is yours. Not only did I just prove that it is yours, I'm now going to put it on the report that I proved that it is yours because you're a liar.
Wow.
That's how they communicate with each other.
Interesting. So the bureaus are starting to learn if somebody's abusing that approach, basically.
The bureaus are gigantic. The best way I can explain, okay? Think of the credit bureaus as a gigantic file cabinet. Okay, they don't even check, you know this, they don't even check the information that is being put into those file cabinets anymore. Hence why companies like mine are so freaking successful.
Right.
Right? You can look this up. The CFPB just sued Experian. When was it? January 7th of this year. And when you find the article, the title says CFPB sues Experian for sham investigations of consumer report errors. Meaning people are concerned about their credit. They see things on there that don't make sense. They send a proper dispute to Experian. Experian did nothing about it. So
that's crazy.
But it's our right? Like we
Right.
have the right to leverage this.
Now,
that's just a little bit of insight there.
Let's close with the
Medical.
cliffhanger that we've given them, medical collections. And then if there's, let's close on that and anything else you feel like we missed that's critical so that we can kind of close this one out.
I think that we cover the nitty gritty, dirty little secrets because everything else, you can find online. But to me, like the very valuable things is, the myths and how you can build credit is super important. Being able to understand the difference between an online algorithm versus a mortgage algorithm. And then the medical bill. So the medical bill has a timeline to it. And this started on July of 2023 is when they passed what we call phase one. So phase one states that paid collections of medical nature will no longer be reported on the credit bureaus. Okay. I had a bill, went to collections. It's medical nature, whatever it was, I pay it, right? And unlike the example that we gave earlier with Verizon, where they can go and put it back on your report or update it, they have to take it out, okay? Medical collections of $0 no longer legally can be put on the credit report, July 2023. Fast forward a year, July 2024. Two huge things for us as consumers. Number one, medical collections under $500 can no longer be reported. Now, good and bad, right? People are going to be like, oh, thank God I can settle that. Poof, gone.
Right.
And some people are going to be like, oh, my bill is $450. You're never getting that money back.
Right.
One other thing. But the point is, medical collections under $500 can no longer go on the credit report. And the other piece, this is super important. When the medical facility, the clinic, the hospital, the physical therapist sells the account to a collection agency, right? And most companies keep their accounts with collection efforts for 6 months. Medical facilities are not in the business of collecting money, right? That's not their business. So they're going to sell it to a collection agency way quicker.
Yeah, almost immediately.
Yeah, exactly. Yeah. I mean, that's not their business.
Right.
Right. So the hospital sells it. Whoever purchased that medical collection cannot put it on the credit report for 12 months.
Oh, wow. That's coming in July of 24.
That already happened.
Oh, that already happened. Okay.
Yeah. July of 2024. Man, we're
almost
in July of 2025.
Yeah.
But the idea is like, hey, I got this bill and you're like, well, I don't see it on your credit report, call them right away, make a payment program, right?
Because then they
And then
won't
that way it
report it.
will never hit your report.
Got it. That's actually awesome. I didn't know that.
It's super, super, super good because how many people, like I just told you today about what I had to do this morning, a $1,700 MRI,
Right. Right.
right? Like, I don't know how many people can just fork up $1,700,
Mm-hmm.
but you can make a payment program and it will never hit your credit. So that's
Wow.
awesome. Now, in that 12-month, right, from the facilities, from the medical facilities to the collection agencies, in that 12-month period is what I like to call limbo. I think that I've been very specific with my answers. This one, I don't have an answer. It just sits there. It's money that's sitting there that it's not with the medical facilities. It's owned by a collection agency, but it's not yet reported. It's approximately $49 billion.
Oh my gosh. Wow.
Brock, we owe today $223 billion in medical debt.
Wow.
The only thing that we have higher is going to be student loans, and higher than that, well, no, credit cards. We owe $1.24 trillion in credit cards. That's
And
an issue.
rising.
They're not stopping us, man.
Yeah.
They're not
Yeah.
stopping us. So, anyways, there's that $49 billion that's sitting there. And you can Google this too. The CFPB passed a ruling, right, or a proposal on, funny enough, June 7th, the same time that they sue Experian, saying that they want to remove medical collections from the credit reports. Okay, that's the tagline. That's what everybody sees, the big letters.
Mm-hmm.
Nobody took the time to continue reading a 3-page article. And what they're talking about is those 49 billions that are sitting in limbo, right? That I'm talking about. That's what they're trying to remove.
They're
It
trying to
affects
like just eliminate the debt.
They're trying to, right. But your face says exactly the reaction that most people will have. It's like, wait a second, you can't just poof, make 46. Then why would you be a doctor? Why would you become a
Right.
physical therapist if I can plain and simple not pay you? It doesn't make sense, right?
No, not at
So
all.
that they filed that regulation with the United States Registry. It's still sitting there.
Mm.
Okay. I personally believe that we're going to see a resolution to the trigger leads issue before we see what happens with this. Because guess what? After that article goes out and everybody goes crazy on social media about medical bills are getting deleted from the credit report, we haven't heard a beep.
Wow.
We don't know what's going to happen. The medical bills are still there, by the way. They weren't removed. They're
Right.
still
Right.
there. And the other thing is this, they cannot retroactively go and erase medical bills from the past.
Mm-hmm.
So saying that medical bills are not going to go on a credit report, it's very, very dangerous.
Mm.
Medical bills that are under $500 are no longer legally going to be reported. Do you still owe the money? Yeah. Are
Right.
they still going to make collection efforts? Yeah. If they try to remove that $49 billion, Brock, I truly believe that just like in 2017 when we saw LexisNexis, right? They stopped putting liens and judgments on the credit report, remember? And
Mm-hmm.
LexisNexis was like, hey, I'll do that. I'll report that. So now as a loan officer, you're pulling LexisNexis, Cavers, Equifax,
Right.
Union.
Right. It just costs more money now to get
You see what
loans
I'm
done.
saying? So get ready because if trigger leads go away, the cost of a credit report is going to rise. If medical bills go away from the credit bureaus altogether, I truly believe that we're going to see the birth of some type of new agency. They're not going to
Mm.
just lay down and let 220 some billion dollars go away. It's just not
That's
going to happen.
crazy.
So
Dang.
if you have medical bills that have not yet hit your credit report, call them up,
Settle
make an
them now.
arrangement. Yeah, make an arrangement, right? 15
Yeah.
bucks a month is all I can pay you.
Yeah.
Um, if it's under 500 bucks or it's $502, settle it and poof, it'll go away.
Yeah. And you have more leverage in that case if it's under 500 because now they have
100%.
less. Yeah. That's
100%.
awesome. Well, this was huge, JP. Thank you so much for spending. I know we've been planning this for a long time, and it was really, really good. We probably need to do another episode like this because there's so much information. We could probably get into some other topics, but I really appreciate it. Tell them where they can find you guys. I know if they talk to us, we refer people to you all the time, but if somebody needs some help or has some questions about credit, UQUAL is a great resource. It's who we trust with all of our clients. So tell them real quickly how they can reach you guys.
Yeah, so they can connect with us at uqual.com or call our corporate at 833-498-7825. If it's a client that's looking to purchase a home, we highly, highly recommend that they connect with Brock at Cross Country first. We've been a partner with Cross Country for years. They actually give their clients a wonderful, wonderful discount. Personally, you can find me talking crap about the credit bureaus on Instagram at @MattAboutCredit. And yeah, man, I invite questions. Like, we absolutely can do this again, but it would be amazing just to get a bunch of questions about things that people want to know about or get an answer to. And then we can just do that rapid fire. So
cool. Love it. Well, I'm glad you bring that up. We are happy. Anybody that's interested and needs support, we are happy to help. And with the inquiry through us referring over to UQUAL is a pretty steep discount. So feel free to lean on us. You know how to reach us. I said that at the beginning of the video, but you can find us at Loans Elevated on all platforms. Please be sure that you like, subscribe, follow, do all the things. Loans Elevated. That's every platform, podcast, YouTube, the website, everything. And again, JP, thank you. And everybody for tuning in. I appreciate it. And hopefully this brought a lot of value. Please share this episode because it's one that everybody needs to hear.
Thank you for tuning in. For more industry insights, follow us on all platforms at Loans Elevated.
And to get in touch with our team, call or text 801-713-4000 or visit loanselevated.com.